Welcome to the Real Estate Jam Session. Today we're going to be touching on industrial real estate. Why? Because it's one of the hottest topics out there. And I've got Chad Griffiths. Chad is a broker, investor, he even has his own industrial real estate podcast. It's out every week. You're going to want to check it out. But Chad walks us through everything going on with industrial real estate. That includes real estate investment trusts, syndications, and more. So make sure you check out the video and give us a like while you're there. Now, if you're new to the channel, my name is Joe Killinger. I've been a real estate entrepreneur for a long time. We'll just leave it at that. And I've done everything from entrepreneurship to brokerage to investing. And I use this channel to bring on guests like Chad and really walk you through what's going on in their segment of the industry and give you tips and tricks that works well for them, and advice, of course. But make sure you check out the video, give us a like, and while you're there, if you haven't done so, make sure you subscribe. Chad, thank you for coming on the show today. I think, with what we're going through with retail and the fulfillment centers, and, I think there's a lot of changes coming in industrial real estate. Could you give us an update of what's going on in industrial right now?
Yeah. And thanks for having me back on the show, Joe. It's always great to chat with you. Industrial is interesting. It has historically been a very stable asset class that hasn't had these big ups and downs like we've seen in other asset classes, most notably office and retail. But over the past couple of years, it went from that really stable asset class to a boom in 2020 following the pandemic. Everybody was transitioning to e-commerce. That e-commerce just requires a lot more warehouse infrastructure in the supply chain. So we saw this big run up in warehouses and industrial real estate in general, coming from about the summer of 2020 until now. And I say now because I think that there is actually a shift that's going to happen for the rest of the year here. It hasn't fully been factored in yet, but Amazon just announced that quarter over quarter e-commerce growth actually declined 3%. So the world's largest e-commerce company had a decline in e-commerce growth. And in that report, they also said that they've essentially hit as much warehouse space as they need. So the world's biggest user of warehouse space said that e-commerce sales are declining and they've maxed out the amount of real estate that they want. So I extrapolate that out, that other companies along that same line, whether they're dedicated e-commerce providers or just companies that have multi-channel or omni-channel distribution, so they'll have some brick and mortar and they'll have some e-commerce side, they're going to see the same impacts as the world's largest e-commerce company will. So I think that the demand, which has been rampant for the last 2 years, like crazy, nobody could have predicted how much demand would have had to happen. Like Dallas is a really good example. They've got about 45 million square feet worth of industrial space currently under development. And that's a massive chunk of industrial real estate. And that was being brought online to accommodate this growth forecast. But
so that's not spec. That's properties that they're already leased out and ready to go.
Yeah, I'm guessing it was probably
probably some spec,
probably some of each. I'm sure that they do have pre-leasing or some of that one that's closer to being done. That probably has been leased already. But the fact that they brought on that much was they're anticipating that demand is going to continue. And you and I both know, having been through a few cycles, that the real estate can go up and demand can go up, but there's always going to be some sort of a mechanism or some sort of event that causes demand to taper down, and that's where you work through the cycle. I think we've hit that peak where the amount of demand that we need for warehouse space is probably going to flatten off, and in some markets we might even see a bit of a decline.
Do you think that the warehouse space now, I don't know, is Amazon going to sublease some of their space out? Is that their plan, or are they're going to just not grow anymore?
I think it'll be difficult to sublease that space out. Just for the most part, those were all built as single purpose buildings specific for one tenant that's in there. So either they'd have to do an all or none type of situation, either lease the whole thing or keep it. And I'm guessing that a lot of those were integral in their supply chain strategy. So I don't foresee that they would sublease any of those out. But if they see demand continuing to falter, they might be able to consolidate operations into a few regional facilities, as opposed to, in my market, as an example, we're about 1 million people in our market. We have 3 major distribution centers from Amazon right now. So depending on how much this demand changes in the coming 2022 here, they conceivably could consolidate that into 1 or 2 of them. They certainly won't be adding more if they've emphatically stated that they hit their capacity.
Yeah.
So what I think best case scenario for Amazon anyways is that they stay the same. What could happen is that they do try to consolidate and sublease out buildings. I think that is a possibility going into 2022 here.
Yeah, I think because I just read somewhere, I don't remember where, but it was said that there's demand for up to 850, they expect a demand of 850 million more square feet of industrial by 2023 or 2020, I think the end of 2023. But I read that a little bit ago. So, the last few weeks, I'm hearing exactly what you're saying is that, demand is slowing, but, I don't know what the vacancy rate is across the country. Do you know what the vacancy rate is over here?
In your market, the industrial real estate market in California, mostly on the port cities like Orange County or the Inland Empire, you're sub 1%. And if you look at major port cities right now, New York is sub 2%, Vancouver sub 1%, Toronto sub 1%. So some of these big cities right now have vacancy rate that's essentially zero. So I think that that's also worth framing in this context as well, is that I believe that demand is going to slow, not necessarily decline across the board, but it's not going to continue at this crazy pace that we saw the past 2 years. It is going to slow, but because vacancy rates are so low in many of the hottest markets in North America and the world, I don't think that's necessarily a bad thing either. Because when you have sub 1% vacancy, it's difficult for companies to lease space. They don't have options available. They see price increases across the board anytime they want to lease space or renew where they're at. A market that's skewed towards the landlord, it doesn't create a favorable situation for the tenant either. So I don't think if we saw vacancy rate increase 100 or 200 basis points in some of these markets, I don't think that that's necessarily a bad thing for the market as a whole. That might be difficult for some of these new projects that are going up where they have forecasted large increases in their rent over their pro forma. That might cause them to adjust their numbers, particularly when we're in a rising interest rate environment as well. So I think that that'll be really fascinating to watch over the next 6 to 18 months, is what is going to happen when we have rising interest rates, makes debt more expensive for all these real estate developers and owners. And we're probably going to be in a little bit of a softening market where it's not going to be as overheated, at least as it has been in the past 18 months for sure, but even going back to March of 2020.
Okay. Now, if I was wanting to be an investor in industrial, what path would I be going? I see it as still a good investment. It's not crazy like it was before. Or it doesn't look like it's going to be crazy like it was before. But, do I do syndications, real estate investment trusts, buy the assets? What do you think is a good way to really get into investing in industrial right now?
Well, I've done all three personally. I've got my own assets that I own that are physical assets that I own myself or with a couple partners. I've done the syndicate as a limited partner, and I've invested in real estate investment trusts on the stock market. I just sold all my REITs.
Oh, you did?
Right as all of them. And I was a big advocate of it. I had Prologis, I had Stag, I had Duke, and a couple smaller ones as well. I sold all of them right as this market started going down. And there's a few reasons for it. I think the market as a whole, as we all know, anyone that's holding stocks right now, it's been a rough month or so here.
I cry every morning.
Oh yeah, I just like that one emoji where your
eyes are a little red from it, but yeah.
It's tough to watch that. So I think that's dragged down the REITs, and I think that this softening demand, or at least the potential for softening demand, it will be interesting to see more quarterly reports come out from some of these publicly traded companies to see if they're also going to be showing a decline in e-commerce sales. Because if it's a trend larger than just Amazon, then I think this will manifest into a bigger problem. If it's just restricted to Amazon and maybe they just grew too much, they added too much space and they were ahead of themselves and it was isolated to just them, then perhaps that's not as big of an issue as we think. But if e-commerce is softening across the board, I myself as an investor would be a little hesitant to look at a project right now, at least until we had a better idea of what's going to happen. Where do interest rates stop? Or do we see another 50, 100 basis point increase this year? What does that do to the market? What is going to be the demand going forward from these e-commerce companies that are occupying a considerable amount of warehouse space? I wouldn't I wouldn't turn away from a deal. I would still look at deals, and I still actively do myself. I would just be very cautious on what those deals are structured at. So was it a deal that just had a lease signed last year at the absolute
Mhm.
height of the market? And if so, what happens if we go into a little bit of a downturn here, whether it's just a general economic recession or whether it's specific to softening demand for warehouse space? What happens if we go into an environment like that? Are those lease rates going to be sustainable for when that tenant comes up for renewal? And if it's a 10-year deal, maybe you don't even have to worry about it. Maybe you just look at it as you've got a really good tenant in there. They're going to be paying X amount for 10 years. Figure it out in 10 years. Nobody knows what's going to happen in 10 years. I take the basis that over any 10-year period, it's probably going to trend upwards. Just historically, that's the way that has, at least in my lifetime. So I kind of take the approach that if you have something for 10 years, great. I think that you can ignore all these aberrations in the market on what's happening on a month-to-month or year-to-year basis. But if you're buying a building that perhaps has a tenant coming up in 2 years and the lease rate is set higher than you think it can lease out for, you've got to factor that into your investment analysis. Otherwise, if you have to take on a new tenant at a lower lease rate, just by extension of capitalizing that loss in income stream, you're going to have a lower price on your hands. So I think it's now more than ever, people are looking at industrial deals with the lowest caps I've ever seen in my career, with the highest projections, the most bullish news out there. You and I both know, Joe, every time you turn on a news or specifically anything related to commercial real estate, industrial, everyone's just glowing about how great industrial is. And
Right.
Prologis isn't doing anyone any favors. They said that they're expecting 22% revenue growth on their rental portfolio this year. So when the largest owner of industrial real estate says they expect 22% growth on their income,
Yeah.
everybody just gets this hype fever that this market is just going to keep going to the moon. And I think the reality is that there are a lot of external pressures right now that should cause people to just be a little bit more skeptical on whether we will see 22% growth or whether there is some potential downward pressure on that.
Yeah, I think, getting back to the fundamentals, it's really, it's honestly, it's been easier to make money the last 10 years than it's going to be going forward. You're going to have to get back to your fundamentals. There's investing and there's speculating. Investing, you look at the numbers, you make sure it's going to work for you. Speculating is buying and hoping that it's going to go up in a certain market. And you want to be an investor, not a speculator going forward. I think there was, the speculators had a lot less risk over the last several years. But going forward, the fundamentals, I just told this story because I've been through a few of these downturns, right? Is when we went through the dot-com bubble here in Los Angeles, all these people running around, they're building these websites and they're like, this is a way to invest. Warren Buffett doesn't know what he's doing.
Mm-hmm.
He's washed up. I think at that time he was in his late 70s, early 80s. And then we went through the apps and they're running, kids are running, or people running around Los Angeles. Warren Buffett doesn't know what he's doing. He's pushing fundamentals all the time, right? Well, he's 92 now. And, he made a comment the other day. He goes, well, eventually I'm going to prove him right because I'm going to be dead. But, it's the fundamentals always make for the best base. You want to make sure you buy for the right reason.
Yeah, and that's very well said, Joe. And I would echo those comments as well, that over the past few years, a lot of industrial investors probably didn't even think of that downside risk. They just thought, okay, well, the market's going to be crazy. Let's buy this. We can anticipate 3 to 5% growth in our pro forma. And that's all that they looked at. They just looked at the sunny side of owning real estate. Whereas I think what I would recommend and what I would do myself anyways, is really start calculating that downside risk again. So whether you're just doing a basic sensitivity analysis, what happens if you can only renew at $6 a square foot where your lease says $8 a square foot right now? That's an exercise that a lot of people haven't had to do over the past few years because it only has gone up. But I think it's just incumbent on people right now, more than any time recently anyways, to just really look at that from what is the worst case scenario on this project that I'm considering investing, whether you're doing it yourself, whether you're going in as a limited partner. Really understand what what can go wrong on this? Let's say interest rates go up another 150 basis points. Let's say that other companies come out and say we're seeing softening sales as well. We're going to restrict the amount of space we need going forward. What is that worst case scenario? What does that do to the underlying lease rate of that property? And if you did have to lease it at 20% or maybe even 40% less than what it's currently listed at right now, can you still afford to do that? If essentially it gets to the point where maybe the profit dries up and maybe there even needs to be cash outlays just to support the debt or support other expenses on there, can you afford to do that? And if you can, I'm with you on this 100%. I think industrial real estate is still going to be a great asset class going forward, but it's probably likely that we're just going to see it keep pace with inflation to some extent. Like I don't see that we're going to have 22% growth this year. I just, all the factors that are in there. I know Prologis has much smarter people working on it than I am, and they've paid people to analyze the different market. But I just can't see another 20% increase this year. If anything, I think we're going to actually see it flatline or perhaps even decline based on what we're seeing right now. And as long as the investors going through those motions and saying, okay, well, if everything does go wrong and we have to lease this space at X price, and I can still make that work for 2 years or however long it takes to have a recovery, then in the long term, I think it's largely irrelevant, these short-term aberrations. I've been through some severe recessions as well. And as bad as it feels at that time, you always come out of it. Like it's like even the Great Recession of 2009, that one really like that hurt. But
Yes,
two
it
years
did.
later, years later, the market was flying again, right? So it's it might hurt in the short term, and there are going to be people that are over leveraged or they're too bullish. They've got rosy sunglasses on, where they just think everything's going to be great going forward. And these market cycles are really a powerful reminder to people that the market just doesn't go up forever. And that's been a constant in economic history, that they're always going through these cycles. So if we are going to go through a cycle, I personally believe that the mania for industrial real estate has peaked. That's my prediction. I'm just a random guy that loves reading about industrial
You're
real
an
estate.
investor. You own a good number of properties too. I know that for a fact. So you're a great resource for this. I mean, but again, and you're looking at the fundamentals of your clients. I mean, everything I'm hearing you say is, really, if you're an owner, make sure you really vet this potential tenant out and make sure that, their company, if they are going to get some lean times ahead, how are you going to work with them? Maybe you have to, blend and extend or whatever you can do. I talked to a guy last week and he was trying to buy industrial in LA, which there isn't any, but for the most part, but he was looking for the bigger properties he could split up. He could take, if he had 40,000 square feet, let's make it 20 and, let's find 220,000. Because he kind of thinks that's the way to really go at it. So people are getting creative. And especially have been in the business for a while. I think it's going to create a lot of opportunity for people.
I agree completely. Being creative is going to be key, and just shifting the mindset with the shifting economic times. Like it's clear to me that we are going to see a bit of a roller coaster in 2022, just with a potential recession on the horizon. There's still the uncertainty of the war and what the ultimate outcome on that is. There's a lot of reasons to actually be pessimistic in the short term, but I think like most successful investors, you take a more positive medium to long term approach, and you just treat these temporary things as what they are. It's something that comes into the world. It doesn't seem to last that long, COVID being a good example, but you have to deal with that situation as it comes up. So I think, just to piggyback on what I'd recommend and what I'd be doing is like you said, Joe, be creative. You have to adapt. You have to respond to these market conditions. You can't just sit on a portfolio and expect it to keep going up forever. You have to be responsive and nimble, and really just treat a property, whatever it is, and any investment, you really just have to treat it as a living, breathing organism that you have to respond to. You have to water it just like a plant. You have to water it, make sure that it's well taken care of, and given enough time and the resilience to see these short-term things through. I still believe it's a world-class investment, and it's why I've got the majority of my net worth directly tied into it.
Yeah, me too. I think it's a great asset class. Easy to manage. You can own it out of state, and it's pretty easy peasy to handle. So, well, Chad, thank you very much for coming on today. I appreciate you hearing your insights and coming from the brokerage and the investor side. It's very powerful for our subscribers. So I thank you very much.
Well, thanks for having me on again, Joe. Always great to catch up. And
I'll
sure
get you back
we'll be in touch
again.
down
We'll
the
have
road.
to do this again soon. We got to keep updated on industrial. For those of you watching today, make sure you check out the video and give us a like. And Chad, let's do this again soon, okay?
We're going to do it in your studio in LA one of these days.
You betcha. Come on out. We'll have some fun.
Thanks, Joe.
Thank you.